The FDIC is not an inefficiency at all. Whatever it takes to fund and back the FDIC is something that will remain in place most likely. That having been said, that same confidence can be something that can backfire against us. Now I want to talk about the one where your money could be at risk that isn't talked about very much, that is a very real thing. That's called bail-ins. Bail-ins are the inverse of what we've heard in the 2008 crisis of basically bailouts. So bailouts was something that when banks and other financial institutions were making bad and risky bets, and some of them were starting to collapse, many of them were so large that if they were to collapse on their own, as the private market would normally, in the free market would normally dictate, they would have pulled the entire US economy down with it. There's no doubt the first 60 to 70 days of Trump's administration have been pure chaos. Whether controlled chaos or not is going to turn out to be a different story. But one may be asking themselves, with so many government agencies and entities under fire from the administration, being vetted for even being qualified to exist in the United States government, one may ask themselves, are my deposits safe at the bank? FDIC is a government agency. It's a federal insurance provided by a government agency. So the question may lie, posed to me at least by one of my clients, are my deposits safe? Is FDIC at risk of being in the crosshairs of Trump's administration? We're going to answer that question. What is FDIC insurance in the first place? How does it work? What is the president's capacity to influence it? Is it something that could potentially be scrapped or be tampered with? And ultimately, the total conclusion on whether your money is safe and what alternatives might be if you feel it is not safe. And I'm going to drop a bonus on an alternative way that your money could be at risk at the bank if things get bad enough. So stick around to the end. This is JP from Blueprint for Prosperity Network, providing you with the insights that you need to master your banking relationship and your lending needs so you can customize your blueprint for prosperity. So what is FDIC insurance? I printed out some information. I'm going to quickly read some bullet points out to you, and they'll be on the screen as I cover them. Going over what FDIC insurance is, how it works, basically when it was created, what the president's capacity to influence or affect FDIC insurance. And that'll give us some insight on whether or not we have to be concerned or if there's even any motivation for President Trump to disturb FDIC insurance, potentially what the outcome could be if it were not in place. So FDIC is the Federal Deposit Insurance Corporation, protects depositors' money if insured banks fail. FDIC insurance is automatic for accounts opened under FDIC insured banks, which is the vast majority of financial institutions out there. So what are the insurance limits? How does it work? FDIC insures up to $250,000 per depositor per ownership category per insured bank. Very important breakdown. How is it paid? FDIC pays insurance to depositors when banks fail. How is it dispersed? If the FDIC may provide a new account at another insured bank and issue a check to the depositor. So essentially what they're going to do if the worst came to worst and the bank that you're at fails, they're going to find another bank that is FDIC insured, that is stable, open you an account there and cover your losses up to $250,000 of your money. When is it applied? Insurance applies to deposits in single accounts, joint accounts, retirement accounts, trust accounts, and business accounts. Also very important to note, FDIC insurance does not protect against losses due to theft or fraud. FDIC maintains the deposit insurance to help fund resolution activities when banks fail, which we experienced in early 2023. So for those of you who are curious how likely this is to happen, we had 2 significant bank failures in early 2023. Keep that in mind. FDIC helps maintain stability and public confidence in the U.S. financial system. Very important as well. So FDIC is an independent agency of the United States government. Congress created the FDIC to protect banks, depositors, and maintain the financial system stability. Its responsibilities ensures deposits in banks, savings associations, examines and supervises financial institutions, manages receiverships, and makes large financial institutions resolvable. FDIC is funded by premiums paid by banks and savings associations for deposit insurance coverage. Also earns interest on funds invested in the U.S. government obligations. Also 2 important keynotes. So basically, this is not directly funded by the U.S. government taxpayer dollar itself. Banks are basically paying premiums. And this is also money that is invested in U.S. government obligations. So think of bonds. All right, really important. So FDIC is managed by a 5-person board of directors appointed by the U.S. president. So the U.S. president does not have direct authority, but they are putting the people in place who have direct authority. Very important as well. The board includes a chairman, vice chairman, director, Comptroller of the Currency, Director of Office of Thrift Supervision. So the U.S. government does not directly fund it, but it is backed by the full faith of the U.S. government. So now that we have a little bit of insight on basically how this works, we know that the FDIC is not directly funded by the government. We know that it's basically funded by bank premiums, and we know that it's backed by the U.S. government. We also know that the FDIC insurance is not directly controlled by the president, but the president appoints the 5 people who do directly control the FDIC. So basically, this is a form of confidence and stability. FDIC insurance is going to be what gives us the confidence to even leave money in the bank in the first place. We know that banks, basically their business model is largely predicated off of us leaving deposits in the bank. If we don't have that confidence and we don't keep our deposits in the bank, then what ends up happening is banks can't lend money. They also can't earn fees. If they can't lend money, they can't lend money out to businesses. If they can't lend money out to businesses, businesses aren't funded. Our entire economic system falls apart. So FDIC insurance is pivotal. It is not likely to be something to be in the crosshairs of President Trump, as they are skimming through government agencies to find inefficiencies. The FDIC is not an inefficiency at all. Whatever it takes to fund and back the FDIC is something that will remain in place most likely. That having been said, that same confidence can be something that can backfire against us. Now I want to talk about the one where your money could be at risk that isn't talked about very much. That is a very real thing. That's called bail-ins. Bail-ins are the inverse of what we've heard in the 2008 crisis of basically bailouts. So bailouts were something that when banks and other financial institutions were making bad and risky bets, and some of them were starting to collapse, many of them were so large that if they were to collapse on their own, as the private market would normally, and the free market would normally dictate, they would have pulled the entire U.S. economy down with it. So the federal government had an obligation to use taxpayer money to bail out these, risk-taking financial institutions, we'll say, for lack of a better term. Basically, they were gambling. And when it didn't go well, the taxpayers were left on the hook to cover those financial institutions. Think Lehman Brothers as a major example in the 2008 crisis, and other financial institutions that did receive taxpayer money to stay afloat. Bail-ins are basically the inverse of that. And this is something really important that isn't necessarily tied to Trump and his policies, but indirectly tied to Trump and his policies. If you're somebody who believes that President Trump's policies could lead to economic disaster, I'm not saying I do, but I know that many of you are concerned of that. If you are concerned that Trump's federal policies and everything he's pushing out, fiscal policies and other policies that he's pushing out, could lead to economic implosion or at least economic hardship, which banks have already been collapsing about a year or 2 years ago at the time of this recording, without the same amount of strain and pressure that's on the economic system today, and what many of you may believe is to come. If that's the case, then banks failing or a cascading collapse of banks becomes more probable or possible. If that's the case, bail-ins could kick in. What are bail-ins and how do they work and how could they put your money at risk? Bail-ins are when creditors are repaid with shares of restructured banks, or to put that in plain English, equity holders may lose some or all of their investments. So basically, if a bank starts to collapse or struggle, they can take the deposits they have on hand from their clientele base to make themselves whole or to stay afloat. Bail-ins can help improve market discipline by making it more expensive for riskier banks to borrow money. Bail-ins can reduce moral hazard by limiting the amount of shares can be gained during a financial crisis. How do bail-ins compare to bailouts? Bail-ins are different from bailouts, which are funded by taxpayers and involve outside parties rescuing a bank. Bail-ins are intended to help reduce the burden on taxpayers. This was basically created during Dodd-Frank Act, which was back in the 2008 crisis or birthed in the 2008 crisis. In short, in plain English, bail-ins are the possibility of banks and financial institutions or investment firms, etc., having to basically take the deposits they have on hand from their clientele in part to make themselves whole or to stay afloat. So this is something that can be kept in mind, not a high probability. I'm not creating fear porn when I say this, but a lot of people don't even know bail-ins are a thing. The last time this happened in modern time was in Cyprus, which is like an island in Europe or off of the coast of Europe. Bail-ins were a thing. People who were banking at a particular financial institution that ran into some serious hardship basically locked the bank down and to use those deposits to stay afloat. This can lead to a scenario where your money is tied up for weeks, months, possibly indefinitely. Who knows? So that having been the case, These are the types of concerns you have to keep in mind. Now that having been said, I'm not advocating that you don't bank or that you don't keep your money in the bank. What I am telling you is you have to be mindful of what risk may be at hand by keeping your money in the bank. As strong and as big as some of these financial institutions are, they are not impervious to policy. They're not impervious to economic woes. At the end of the day, they can end up falling on their face and either robbing you from the front end as a taxpayer or the back end as a taxpayer or from the front end as a depositor. It's possible. Alternatives that might be something you can consider are keeping your money in insurance policies, for instance. Some of you may be familiar with this as bank on yourself or velocity banking or all of these different terms. At the end of the day, there exists well-constructed insurance policies that are basically backed and stabilized on the state level versus the federal level. And insurance companies are regulated by the state. So when you put these policies together, where basically they're called high cash value policies, you can basically stuff a bunch of your money into these policies and access it in relatively short windows of time, allowing you to actually get dividends in return, because the insurance companies that do these types of policies are mutual insurance companies. So they're equivalents of credit unions in the banking system, where you are basically a member or you are the owner of that, part owner of that insurance company. So just like your membership is ownership or stake in the credit union, mutual insurance companies are where you basically have ownership or stake in that insurance company. And so when they make investments and they're able to pay back dividends, those dividends come back to you as a policyholder. You can stuff a bunch of cash value into these policies. I've owned a couple of them myself. They're a pretty good way to stock money and kind of create your own little banking ecosystem. I'm not going to go into grave detail on this because it's a whole long chapter in itself, but I'm just putting out an alternative for you. Another alternative is you can invest the money and keep it into, a cash position in investments. That will fall under FDIC insurance, where you're not protected from market loss if you invest in that way. But if that firm collapses, essentially, you can be back that way. Now that, again, can fall in that bail-in category, but you have insurance companies that are completely separate from this. That could be a really good alternative if you're somebody who's really concerned. Other than that, you can do things like gold and silver, which don't have third-party counter risk at all. You physically hold that, but you do have market fluctuations to keep in mind with that. But it is an alternative if you're somebody really concerned about the banking system from a policy perspective, as far as Trump just raiding things or cutting things, etc., and affecting FDIC insurance, or if you're worried about banks collapsing from back-end policies or economic circumstances and the bail-in thing coming into play. So I just wanted to put this out there. I had a client bring this to me in a sit-down interaction where she's was renewing her CD for about $100,000. We have been doing this for about 2 years, taking advantage of the unique rates that we've had in the last 20 years. And she sat down straight up and asked me, like, listen, with everything going on with the current administration, what is the likelihood that FDIC insurance is disturbed? Is my money at risk? Like, how does this work? And so I thought it was a phenomenal question. All of us keep our money in the bank on some level, and it is important to know if our money is safe or not. And with the current shifts and changes going on, agencies being turned on their heads, people getting laid off, it's a valid question. Comment down below. Let me know what you think. As a depositor at your bank, does the risk of FDIC insurance being disturbed or bail-ins make you fearful in any form of fashion? At your bank, are you completely confident? Are you concerned? And what alternatives are you taking if you are concerned to better protect your money and your savings? Comment down below and let me know. To all my pioneers, welcome back. To my new viewers, welcome in. I have finally branched out from YouTube. I have created social media links or accounts that'll be linked in the description. You can follow me. The handle should be somewhere on the screen here. I'm on Instagram at the moment and branching out from there slowly but surely. So if you want to get a little bit more of an intimate look at me, my life, and a little bit more, follow the channel and more we got going on. We are slowly but surely building out our Instagram. You can find the handle somewhere on the screen, links in the description below. Other than that, I want you to like, comment, support the channel. There's new ways to support the channel. You can leave your supers down below as well. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon. This is my blueprint for financial empowerment and self-sufficiency. This is my blueprint for optimal health and body mastery. This is my blueprint for mental, physical, and spiritual momentum. This is my blueprint for prosperity.